Welcome to our CFP exam prep discussion on bond immunization, a crucial concept that frequently appears in the investment portion of the exam. Today, we're diving deep into this strategy that helps match bond durations to investment time horizons for minimizing interest rate risk. Let's break down bond immunization into its core components. Bond immunization is essentially a strategy where we structure a bond portfolio so that any changes in interest rates won't affect our ability to meet future obligations. Think of it as creating a protective shield around your portfolio against interest rate fluctuations. The key principle of immunization revolves around duration matching. We want the duration of our bond portfolio to equal the time horizon of our investment objective. For example, if you need to make a payment in exactly 5 years, you would structure your portfolio to have a duration of 5 years. This way, if interest rates change, the change in the portfolio's value will be offset by the reinvestment opportunities at the new rates. Many candidates make a critical mistake by confusing duration with maturity. Remember that duration measures price sensitivity to interest rate changes, while maturity simply refers to when the bond reaches its end date. Duration considers both the time until cash flows and the size of those cash flows, making it a more comprehensive measure. Here's a practical example that often shows up in exam questions. Let's say a pension fund needs to make a $1 million payment in 7 years. To immunize this liability, the fund manager would create a portfolio with a duration of 7 years. If interest rates increase, the market value of the bonds will decrease, but this will be compensated by higher reinvestment rates on the coupon payments. Another common trap in exam questions involves rebalancing. Immunization isn't a set-it-and-forget-it strategy. As time passes, the duration of both your portfolio and your investment horizon will change. The portfolio needs regular rebalancing to maintain the duration match. This dynamic aspect is something exam writers love to test. When tackling immunization questions on the exam, watch out for these frequent pitfalls. Students often forget that perfect immunization requires certain assumptions, like parallel yield curve shifts. The exam might present scenarios where these assumptions don't hold, testing your understanding of the strategy's limitations. Some test takers also struggle with understanding that immunization works best when protecting against a single future liability. When dealing with multiple liabilities at different time points, the strategy becomes more complex, requiring multiple dedicated portfolios or more sophisticated techniques. A technical point that often trips up candidates is the relationship between convexity and immunization. While basic immunization focuses on duration matching, convexity can provide additional protection against large interest rate movements. The exam might include questions about how convexity affects the effectiveness of an immunization strategy. To solidify your understanding, remember this framework. First, identify the investment horizon or liability date. Second, calculate the required duration for your portfolio. Third, structure your portfolio to match this duration. Finally, plan for regular rebalancing to maintain the match. Mastering bond immunization concepts can significantly boost your performance on the CFP exam. Focus on understanding the practical applications and limitations of the strategy, rather than just memorizing formulas. Practice questions involving duration calculations and portfolio adjustments, as these are the types of problems you're likely to encounter on exam day.